The world of investing can often feel complex. Financial news is filled with jargon, fast-moving charts, bold predictions that rarely seem to pan out. Amidst this noise, some of the most effective tools are often the simplest. One such tool is the Vanguard Total Stock Market ETF, which trades under the ticker symbol VTI. In plain terms, VTI is a fund that you can buy and sell on the stock market, just like a share of a single company. Instead of owning a piece of just one business, owning a share of VTI gives you a small ownership stake in thousands of publicly traded U.S. companies. It is designed to be a one-stop shop for the entire American stock market. The primary purpose of an investment like VTI is diversification. Diversification is the simple idea that you should not put all of your eggs in one basket. By holding a vast number of stocks, VTI ensures that the poor performance of any single company will have a very small impact on your overall investment. It is a simple, powerful way to participate in the potential growth of the U.S. economy. When evaluating any investment fund, the details matter. Three of the most important figures to consider are its fees, its size, and the number of companies it holds. For VTI, these numbers tell a compelling story. VTI has an expense ratio of just 0.03% as of late 2024. In this case, for every $10,000 you have invested in VTI, you will pay just $3 per year in management fees. This is remarkably low and stands in stark contrast to many actively managed funds that can charge 1% or more, a difference that can save an investor tens or even hundreds of thousands of dollars over a lifetime. As of late 2024, VTI manages approximately $1.6 trillion in assets, with the ETF alone holding over $400 billion. VTI holds shares in nearly 4,000 different U.S. companies. While the fund is market cap weighted, meaning larger companies make up a bigger percentage, the inclusion of thousands of small and mid-cap stocks provides a more complete picture than an S&P 500 fund alone. These core numbers, a tiny 0.03% expense ratio, massive assets under management, and a portfolio of nearly 4,000 stocks combine to make VTI a formidable investment vehicle. The low fee ensures that more of your money stays invested and working for you, while the vast holdings deliver true diversification. An investment in VTI is an investment in the underlying businesses it holds, and the value of those businesses is ultimately driven by their earnings. VTI itself does not generate earnings like a company does. Instead, its performance reflects the collective success of the thousands of companies it holds. When the U.S. economy is strong and companies are profitable, stock prices tend to rise, which increases the value of a VTI share. A tangible benefit of owning VTI is the dividends it distributes. Dividends are payments companies make to shareholders, typically from profits. Because VTI holds dividend-paying stocks, it collects and passes those payments to shareholders quarterly. As of late 2024, VTI's trailing 12-month dividend yield has been around 1.4%. That means for every $10,000 invested, you'd have received about $140 in dividends over the past year. From a tax perspective, VTI's dividends are generally qualified dividends for most U.S. taxable accounts. Qualified dividends are taxed at lower capital gains rates, which is an important benefit. The real power is reinvesting dividends to buy more shares and accelerate compounding over time. Ultimately, price appreciation from earnings growth plus a steady, tax-efficient dividend stream make up VTI's total return. For current dividend details, check Vanguard's official distribution history. Tax laws are complex and depend on your situation, so consult a tax professional for personalized advice. Past performance is never a guarantee of future results, but looking at how an investment has behaved in the past can provide valuable context. The U.S. stock market is known for its volatility in the short term, but it has shown a remarkable tendency to grow over the long term. Imagine someone invested $10,000 in VTI at the beginning of 2015. By the end of 2024, despite several periods of market anxiety, a sharp correction in early 2018, the pandemic crash in 2020, the bear market of 2022, that initial investment would have grown significantly through the power of staying the course. An investor who put $10,000 into VTI at the start of 2022 would have had a very different experience. That year was marked by high inflation, rising interest rates, which sent the stock market into a decline. By the end of 2022, that $10,000 investment would have been worth considerably less. This is why financial advisors often recommend a time horizon of at least 5 years, and preferably longer. Consider the experience during a strong bull market year, such as 2021, when substantial growth occurred. However, it is impossible to predict when these strong years will occur. The most reliable strategy has been to buy and hold, accepting the bad years as the price of admission for capturing the good ones. While VTI is an excellent choice for broad U.S. market exposure, it is not the only option available. One of the most common comparisons is between VTI and the Vanguard S&P 500 ETF. VO tracks the S&P 500 index, which consists of about 500 of the largest and most established companies. Because VTI is market cap weighted, these same 500 companies make up about 85% of VTI's portfolio. The main difference lies in VTI's inclusion of thousands of small and mid-sized companies, giving VTI a slight edge in diversification. Another alternative to consider is an international stock fund such as VXUS. VTI is focused exclusively on U.S. companies. Investing is a global activity, and U.S. stocks represent only about half of the world's total stock market value. VXUS provides exposure to thousands of companies in both developed and emerging markets outside the United States. Many financial advisors recommend pairing VTI with a fund like VXUS to build a globally diversified portfolio. For investors seeking an even simpler solution, Vanguard offers the Total World Stock ETF Vermont. VT combines both U.S. and international stocks into a single fund, automatically giving you global diversification. This can be an excellent choice for someone who wants maximum simplicity. The downside is that you lose the ability to control your specific allocation between U.S. and international stocks. VTI offers a pure play on the U.S. market, which you can complement with other funds to build a tailored portfolio. Each option serves different investor preferences, from broad U.S. market exposure to global diversification, all with Vanguard's characteristically low fees. As we stand in 2025, the principles that make VTI attractive remain firmly in place. It offers a simple, effective, extremely low-cost way to own a piece of nearly every publicly traded company in the United States. It is built on the idea that betting on the long-term ingenuity and profitability of the American economy is sound. The decision depends entirely on your personal financial situation, your time horizon, and your tolerance for risk. The stock market does not move up in a straight line. There will be periods of decline, and these can be unsettling. Therefore, it is generally best suited for goals that are at least 5 to 10 years away. Discipline and patience are the essential companions to an investment in VTI. Instead of trying to find the needle in the haystack, you can simply buy the whole haystack. Its combination of comprehensive market exposure, minimal costs, and historical performance makes it compelling. It allows you to participate in U.S. economic growth with a single, straightforward transaction. For anyone considering an investment, the next step is to do your own due diligence. Visit the Vanguard website and search for ticker symbol VTI. There you will find the official fact sheet, prospectus, and recent performance data. In a world of financial complexity, the simplicity of VTI is one of its greatest strengths.